We are having this special chat with the emerging market specialist. I have with me right now Barton Grenning. He's the emerging market fund manager of Nuveen Asset and manages almost $2.3 billion in emerging market assets. Bart, thank you very much for chatting with us today. Now that you're visiting the Edelweiss ESG Conference, before I get into the kind of stocks or companies you've met, just wanted to get a word on emerging market as a pack, because we have underperformed quite a lot, India in particular, emerging market as a basket. Do you think 2019 could turn the fortunes of emerging market pack for good?
Yeah, I do. I mean, I think that potentially EM could be in sort of a golden period. I mean, and if you just look at 2019, you know, we just came out of a double-digit down year last year, and EM only twice in its history has not gone up after suffering a double-digit down year, and that was the Asian financial crisis and post the TMT bubble. And to top that off, you know, the valuation on EM is very cheap. It's like one standard deviation cheap versus history and versus the U.S. and world, and also the growth expectation in EM at only 7% for this year is at a 10-year low. It's the lowest it's been since the recovery in 2009. And so I think the potential for seeing a lot of earnings downgrades in EM is low. And also you're seeing the growth gap between EM and the US and world picking up this year as well. So, you know, EM at this point, with valuation and, you know, the fact that we underperformed so much last year, I think is a good setup for the
there's a consensus when we interact with global money allocators. The consensus is building that mid-year this year in 2019, there could be a stimulus coming in from China to arrest their growth decline. There is already such a lot of talk on how Mr. Powell in US may go slow on their rate hike spree. And if that indeed happens, part of it, of course, in the price, but do you think it's fully not in the price and it may also trigger a risk-on trade in this year?
Yeah, I do think that all these positive factors are not fully in the price. I mean, clearly I think you could argue late last year that the resolution of U.S.-China trade war, which I think is highly probable to occur, was not priced into the market. And now EM's up, you know, year to date, close to 10%. I think some is being priced in, but I still think there's an enormous amount of skepticism around, you know, the trade war between the U.S. and China. If that, you know, China has been a really bad performer last year, and there's a lot of, you know, pretty attractive value in that market. So I think there's still quite a bit of upside with resolution of the trade war. And I guess I'd also add to that you know, I do think with the resolution of the trade war and with the stimulus you mentioned, which I'd point out is much more targeted this time, you know, towards certain sectors and not just the shotgun approach of 2008, I think that will also work. So we'll see probably some stability in the Chinese economy and maybe acceleration later this year. And, you know, again, I think China is a pretty good place to be within EM right now.
Right. So how are asset managers who are operating in the emerging market environment factoring in trade war risks in their portfolio? Because this is something which is new to them. They have not been you know, working their spreadsheets far out in the history, and this is now seem to be or appears like a issue they'll have to grapple in a slow burn manner for next couple of years. So how is this risk being built in?
Well, I'd say a couple things about that. I mean, first of all, I think that the trade war issues have kept a lot of global and international investors who don't have EM in their benchmark away from EM. So I think, you know, they're among like global funds, they're generally, from the data I've seen, underweight EM pretty significantly. So that's one impact of the trade war. And secondly, what I'd say about this slow burn of the trade war, I do think that, you know, even though there is probably going to be a resolution very soon, I don't think it's going to be a permanent long-term solution. I think, you know, China and the U.S. have somewhat entered a new Cold War of sorts. You know, they're both vying for technological, military, and economic leadership in the world. So, you know, I think that they're going to kind of call off the dogs and play nice with each other for a year and a half, and you can see a pretty nice, you know, environment for EM during that time. But maybe going into the 2020 elections, you know, both Democrats and Republicans are going to use China as a whipping boy again. They're going to say they're cheating on the trade terms, and, you know, it could turn into a mess again in the future. But, you know, all we need is a good year and a half of somewhat smooth sailing. People will forget about it. but I'm not going to forget about it completely.
Well, as they say in the market, you have to be fearful before everybody else turns fearful, and turn greedy before everybody else turns greedy.
Exactly.
But how are you analyzing India in the overall emerging market pack, where aggregates may not be still very cheap despite the correction, but rest of the market has gone very cheap in a long time?
Right. No, I agree. I mean, looking at aggregate level valuations and aggregate level data is always a little dangerous. I mean, India does look expensive on that basis, but I mean, some of that's driven by, I think, as we were talking about in that panel before, that FMCG sectors at ludicrous valuations, and I couldn't even consider that, and that kind of drags up some of the market multiples a lot. But there are a lot of pockets of stocks that have gone down, say 40, 50, 60%. They're looking extremely cheap, and as long as there aren't major governance or fraud risks in those companies, and you can be comfortable that they're real businesses. I mean, I think there are some pretty interesting opportunities. I mean, just this week being here, I have probably a handful of stocks I'm very interested in. I mean, in spite of the fact that if you look at India on an aggregate basis, it's not that compelling.
That's interesting to note that you're finding value here. I wouldn't talk to you about which stocks are looking attractive to you, but at least you can talk to us a flavor of the kind of companies you've met, the kind of promoters you've met, and what have you derived out of business mood right now here?
I think people are still bullish on the long term. I mean, there's a lot of reason to be bullish on the long-term outlook of India. I mean, some of the things mentioned are, real interest rates in India are among the highest in emerging markets, so that could be a setup for kind of long-term rate declines, which would be positive for consumption. And I don't think, I think everybody in the market's a little bit nervous because of all these landmines that have occurred on loan against shares and the NBFC crisis and so forth. But India is still growing at 7+%, so it's still compelling. I mean, also, on the stock level, I guess one stock I can probably mention is that I've been long for maybe 2.5 years is Reliance Industries, and that continues to be a big shareholding of mine. I mean, that actually does have a lot of value angles to it.
In fact, I'm glad you brought the Reliance angle, because right now the aggregate valuations are the way Nifty Sensex is held up is also largely because of the weight of Reliance, and which has massively outperformed the market. Do you see value unlocking measures which they've spoken about happen, and the earnings boost which they are talking about? Jio is doing phenomenally well. If you could add some thoughts.
Yeah, I do. I mean, Reliance has a lot going in its favor. I mean, I think they spent in CapEx over the 4 years up until last year, was it $50-60 billion in CapEx? At the time I invested in Reliance, the CapEx that had spent in the previous 4 or 5 years was the entire market cap of the company, right? And they were getting no cash flow from that CapEx they'd spent until maybe a year and a half ago. So, the EBITDA there is going up significantly because of all the kind of mid and downstream investments they made in their core business. And so you're seeing that come through. And then on top of it, Jio has outperformed everyone's highest expectations going into it. And then lastly, I think a part of their business that's kind of ignored to a large extent because it's within this big conglomerate is the retail business. I mean, that could potentially have enormous value. I mean, they're the biggest retailer in India, and their plans for that business are very exciting. And then not to mention on the Jio point, it's more than just a mobile phone company. It's a complete conversions play with fiber to the home and content, and it's basically a company that has attributes that you don't see almost anywhere in the world.
So now they are trying to rival Amazon here in India and taking them head on by combining the footprint of Jio and what they are doing in retail combined. Do you think if they go forward, and even in this part of the business, global majors would love to pick stake, because the management has gone on air and on record to be wanting to delever the balance sheet by stake sales?
Yeah, I mean, I just literally met with them right before we were talking now, and I think a stake sale in the or IPO even of their retail business is not imminent from what it sounds like. But I do think they're doing some value unlocking in terms of the Jio business within the fiber and the tower business. I think that's been in the news, but I think they are going to be on a deleveraging path, which is again another positive for the story. I mean, I'm generally quite happy with Reliance in terms of, if you look at it just on headline valuation numbers and compare it to companies in, say, oil and gas and chemicals, I mean, it's probably a couple points more expensive on EV/EBITDA and PE, but that's completely undervaluing some of the positive aspects on like retail, for example.
Great. Bart, thank you so much for your time. Wonderful chatting with you, and enjoy your stay here.
Yeah.
Thank you. Bye-bye.
Thank you. Thanks.